All right, wanted to take a quick minute, share some thoughts in reference to events from this past week and all the indicators and all the warning signals that have been given that has basically pointed to the fact that we are in a recession. It just hasn't been officially announced yet, and I wouldn't expect it to be whatsoever in the days ahead. It's usually in the midst of, after something breaks, that the powers and the people that try to control the narrative actually comes out and tells us the truth. So my whole goal with these videos here is to warn you as to what to expect, and how if you are warned ahead of time, then hopefully you can do something different to better prepare and to brace for impact, because the warning signs, the alarm bells are already ringing. They're very loud, and only people who focus and pay attention to this type of information will actually be aware and then can hopefully avoid some of the contagion that will inevitably come and hit everybody. But at the end of the day, a powerful economic indicator just flashed red. And if you've been paying attention to the past cycles, then you know what that means. Recession odds are spiking. And so we're not talking about guesswork here, but a pattern that we've seen play out again and again in recent decades. So today I want to dive deeper, break it down into three formative ways in which you can understand it so you can see yourself and why the economy might be on the brink of a downturn. And number one, the yield curve. It has recently uninverted, but that's not necessarily a good thing, or that's not good news. And so the key thing with that is an uninverted yield curve basically means long-term interest rates like the 10-year treasury are now higher than the short-term ones like the 2-year treasury. So this might sound positive. After all, everyone freaks out when the curve inverts. So shouldn't we relax after it flips back? But typically that's how it goes, but not so fast. So if you look back at history, the exact opposite tends to happen. The yield curve has a nasty habit of flattening out, uninverting, and then bam, that's when everything hits you. Recession hits. Think early 90s, dot-com bust, 2008 financial crisis. The pattern is clear. Once the yield curve gets back to normal, trouble often follows. So in fact, it's playing out right now. So this yield curve uninverted about 2 years ago, signaling that short-term rates were higher than long-term ones, but now the curve has uninverted, and that's historically been the sign that a recession is getting closer, if not imminent. So the longer uninversion holds, the greater the chances we're headed for a serious economic downturn, stocks crash and sell off of the debt market, you name it. And in step two, the rising unemployment is another alarm bell you should pay attention to. And so unemployment is a great way to figure out what's going on, because that's the SAM rule, which tracks the 3-month moving average of unemployment compared to the lowest point over the past year. So when it climbs more than 50 basis points, it's historically a surefire sign that recession is on the way. And guess what? We've hit the 50 basis point threshold as of last week with those numbers. So when you lay out this data in the yield curve to that unemployment, you can't ignore this, what's coming. Of course, there's been a rare cases where the alarm bells sounded prematurely, but then again, the recession followed not too much longer after that. Right now, the odds are piling up against us, and we are not really paying attention. So we've got a curve uninverting, unemployment rising, two of the most reliable indicators signaling that recession is in the works. And the last one I want to touch on is the oil prices, because they're crashing as well. So what does that tell us? Now, you throw oil into the mix because energy consumption is a key barometer of economic health. So recently, oil prices have taken a nosedive, even as OPEC cut production in an attempt to prop them up. So normally, less supply means higher prices, right? But not this time. Instead, prices are tanking, which suggests that the demand for oil, by extension, economic activity is slowing down. And it's not just a slight drop either. We're talking about a collapse in oil prices. Just look around now. The price of gas is cheaper. Even historically, higher production cuts. Morgan Stanley recent / oil forecast pointed out that traders are pricing in a demand slowdown akin to the mild recession. And so when you consider the energy as the backbone of the economy, this drop in demand is telling us one thing: economic growth is starting to stall out. So what does all this mean? So when you add all these pieces together, the uninverted yield curve, rising unemployment, and falling oil prices, it's hard to be optimistic about the economy's near-term future. So the Federal Reserve is definitely keeping an eye on this, and it's likely they're going to cut interest rates this upcoming week. Not because they're trying to prevent a recession, but because they're reacting to one that's already in the midst. So don't wait around for the government to announce it either. Or the National Bureau of Economic Research, the NBR, the official body that calls recessions, is always late to the party, just based upon time. So by the time you actually hear about a recession, we've likely been in one for months, just like in '08. And when it's declared, the recession long after the damage is usually done. So while talking heads may say everything's fine, the data tells us a different story. So the yield curve is flipped, unemployment is ticking up, oil demand is collapsing, and together these indicators are pointed towards a rocky road ahead. It's happening now. So you might not hear this on the mainstream media, but it's worth keeping an eye on because the economy is throwing out warning signs left and right. And if history is any guide, the story might not have a happy ending. So just want to take a minute, share with you what I'm keeping my eyes on. Hopefully you too can stay in tune, but definitely expect more volatility in the markets, more uncertainty, more Fed speak, trying to prop things up, trying to make people feel confident that they have everything under control. But ultimately, keep an eye on the price of gold. This week we hit 25.70 or something like that. That's an all-time high when using the USD price. But if you look at the USD price, that's an all-time low if gold was the measuring stick. So just that little play on perspective there can tell a lot. And so while the world is racing to gold, India, China have been quietly accumulating a lot of silver. So hopefully you're watching what they do and hopefully emulating what they're doing by getting out of debt and the liabilities associated with it in proportion to what you can save as far as your purchasing power. But then on top of that, you need to keep some in the system to live. But at the end of the day, you want to be out of harm's way, and harm's way is the debt, which is the currency. And right now, that's all started to unravel right now. So the more, hopefully, the better you can do. So my goal with this video is to reach out to you, tell you what's going on, help you see what I see, and hopefully you can act accordingly and just brace for impact because we're here. This is it. And we're a couple of weeks away from the election. So it's going to be an interesting couple of weeks of fireworks. So stay in tune. Curious to hear your thoughts. Drop a comment. If you find this informative, hit that thumbs up button. Share this so people can find out what's going on. And once again, the goal is just to educate you, keep you plugged in. Hopefully I did that. Catch you guys later.